Bank earnings season is starting with an absolute explosion as JP Morgan stock up over 7% in one day after reporting their Q1 numbers. We will get into them on today's show. We'll take a look at all the different business segments that JPM operates under. Are the doom and gloom prophecies of a banking crisis going to materialize here in the United States? And some of you guys are saying, no, you're crazy. JP Morgan up 7% after reporting earnings. There's no way there's going to be a banking crisis. There's no way there's going to be a banking collapse here in the United States. But look, we will talk about it. Sometimes these reactions to these stocks are actually backward looking, and we'll take a look at the future. We'll take a look at what some of the things that Jamie Dimon said, and we'll take a look at some of the trends inside of JP Morgan Bank that are very interesting. We'll obviously take a look at a high-level view of the company's financials. We'll take a look at the different business segments and see which ones have generated so much revenue growth for the company. And we'll come over here and look at it from a technical perspective. I tell you what, we were sitting here 90 days ago, basically at the same price, probably actually a little bit higher. And I thought for sure that the momentum from a technical perspective was in this stock and it was rallying higher. And I thought for sure it would take us to a higher place on this stock, probably up into the 150s, 160s, maybe even as high as 170 on JP Morgan. Now, clearly that did not happen. In fact, the stock completely broke down, came down here to the 120s, but now here we are again, bouncing back up into the 140s. Can the stock push through this obviously key technical area, key area of resistance? Which direction is JP Morgan stock going to go? We'll talk about that on today's show. Again, the stock is up over 7%, or basically about 7%. We are recording this during the regular trade, so who knows where this one's going to end up. But I tell you what, the reaction by Wall Street very much not pricing in these strong results over at JP Morgan. That is because we have a $378 billion market cap on this one, so a 7% move is absolutely ginormous, and in a lot of ways, very much well-deserved. When you come over here and look at the revenue, $38.3 billion worth of revenue for JPM. That was 24.8% year-over-year growth on that revenue side. They also beat and raised on the earnings side for the full year as well. Folks, you see this with tech stocks. We'll see tech stocks grow their revenues 24%. You almost never see the largest consumer bank, when all the doom and gloom prophecies we're talking about bank runs and bank collapse, JP Morgan grew their revenues 24% year over year, and they beat expectations by over $2.5 billion. So I tell you what, this big of a beat in this quarter for JPM has us wondering, well, okay, what about Q2? What about Q3? Well, Wall Street's they were expecting kind of a high mid-teens growth rate on JP Morgan. They delivered 28%. So we look forward to the next quarter. They're actually expecting kind of sequential declines on the revenue down to about $35 billion. That would still be about 14% growth year over year on that revenue side. Well, what if they do it again? They come into the kind of mid-20s growth rate, and then we're expecting a massive drop-off in revenue growth for the subsequent quarter, really out into next year for JP Morgan. I tell you what, if the company can reaccelerate these revenues, they don't have to be 20% every quarter, but if they can hold this mid-teens and then hold maybe a high single-digit growth rate for the next several quarters, well, the stock's momentum, which we talked about here just a short while ago, it's probably going to continue to go higher. Now, obviously, there's a lot of things inside the banking sector that has people concerned. If you read the note from JP Morgan, he says, and I quote, "The storm clouds that we've been monitoring for the past year remain on the horizon, and the banking industry turmoil adds to these risks." But then he goes on to say that the company has been seeing a massive inflows of deposits, certainly not reflected entirely on these reports, but some of that is evidence of that. Now, what we are seeing, though, when we look at the different consumer business, the corporate, and kind of your small business banking over at JPM, is we're seeing a reversal of what we saw last year. I remember sitting here doing these earnings report last year when it came to JP Morgan, and what was up? Actually, the deposits were up and the average loans were down. So people were basically hoarding cash and they weren't borrowing money. Now what we're seeing is actually a little bit of a reversal, okay? In the consumer side, you're actually seeing average deposits down, average loans up. You look on the corporate side, average loans up by 13%, average deposits down. So obviously good for JP Morgan kind of in the short run. For the broader economy, if this stretches out any length of time, and any length of time is kind of a broad statement, I would say probably longer than 12 months, if you have deposits continuing to get drawn down and people taking on more and more debt, obviously can create some problems for the banking system. Now, broadly on JP Morgan, we'll get into the segment results here more deeply here in a second, but from a book value per share basis, up 9% year over year. From a tangible book value, up 10% year over year. Tangible book is if we had to liquidate JP Morgan. And the thing to understand about tangible book is I like to compare a bank to itself. There's a lot of investors that make the mistake of comparing JP Morgan's tangible book to Citigroup's, or taking JP Morgan's tangible book and comparing it to Wells Fargo and thinking they should trade the same. No, I would only compare a bank's tangible book value history to itself. And so when we look at JP Morgan on Seeking Alpha, if you come to the far right to the charting and then you change this to price to tangible book, you get actually a pretty long history, and you can stretch this out for any length of time. I have stretched this out to 5 years. And what you see in times of distress after 2020, the price to tangible book came around 1.5 times tangible book, which means you take the price to tangible price you get here, times it by 1.5, and you get the share price. JP Morgan is trading just slightly over what I would call quote unquote distress levels for JP Morgan. Now, obviously, you compare this to a Citigroup, a Wells Fargo, a number of other different banks, it seems elevated, but again, we are comparing a bank's tangible book value to itself. In my opinion, that's the best way to analyze this metric. Right now, this likely doesn't factor in the over 7% gain that the stock has had intraday, but right now, JP Morgan stock, not wildly undervalued. It's not cheap. It's not you run out and you go buy a bunch of shares, but it's not also wildly overvalued. And I don't necessarily think that the price to tangible book is factoring in this type of revenue growth and the potential that the company could continue to reaccelerate revenue growth in subsequent quarters. Now, corporate-wide, what we tend to look at when we look at these large banks is we look at these provision for credit losses. Year over year, still up tremendously. So the provision for credit losses, if you're just kind of catching up with how to analyze these banks, essentially the banks have risk managers, which clearly in some cases at some of these smaller banks like SVB Bank, clearly didn't know what they were doing, but the risk managers say, well, we've got this book of business and some of these people are going to default. Some of these people are just going to run out on their loan and not pay us back. And we're going to lose some money on some of the book of business that we have. So they set aside money every quarter. In some quarters, maybe they set aside a little bit too much, and then they release that money back and it flows really all the way down to the earnings per share. Well, in this case, JP Morgan is setting aside a fair amount of money. You see it's up 56% year over year, but it's starting to flatten. Quarter over quarter, they've gone flat here. And so we'll see if the storm clouds, like JP Morgan CEO Jamie Dimon describes them, if they materializes and it starts raining, well, this $2.2 billion is going to get sucked up into the company, and they're going to have to basically recoup some losses that they would have otherwise recognized as revenues and eventually profits. If the storm clouds dissipate, as also Jamie Dimon describes, well, this $2.2 billion and this $2.3 billion, some of this is actually going to flow into subsequent earnings. And so that is the game, and that's kind of the guessing game that Wall Street is going to play. Depending on which side you are on, I believe there's still momentum left in this stock one way or another. But overall, the company grew their revenues by 25%. Their non-interest expense, which is essentially the operating costs for JP Morgan, grew just 5% over the last year. So yeah, your net income is going to skyrocket to the tune of 52%, and your earnings per share also skyrocketing over 56%. The Consumer and Community Bank, this is what most of you likely viewing this video interact with JP Morgan. You've got a credit card with them. Maybe you've got a home loan. Maybe you do some banking, some wealth management, some stock trading, those types of things. Well, that business is humming right along. Look at this, 35% on that net revenue side. Look at the banking and wealth management. You think this company saw some inflows of customers as people started to get scared of these quote unquote regional or smaller banks? Now, what has fallen off the table is home lending. This hasn't impacted the economy, I don't think, yet. We've been seeing this trend when we look at Wells Fargo, certainly other smaller lenders like Upstart, even like a SoFi, drastic decline year over year, 38%. But you did notice quarter over quarter, a 23% increase in home lending. In fact, quarter over quarter, it's the fastest growing business. So the home market basically painting two different stories, and we'll see what happens there. And then finally, you have your card services and autos. This is your credit cards and your automobiles. Year over year up 14%, relatively flat though, quarter over quarter on that revenue side. They've done a nice job over at JP Morgan. They are rapidly expanding these revenues, but look at this non-interest expense. Year over year, just up 5%. Now, what is impacting net income a little bit, although net income year over year went from $2.9 billion. Again, we're just looking at the consumer banking business, up 80% to $5.2 billion. Provision for credit losses expanded over 107%, but did decline sequentially quarter over quarter. We have this $1.4 billion. Again, the company is setting aside money just in case you don't pay back your credit card, your automobile loan, or for some reason you stop paying on your mortgage. They're setting aside more and more money over last year, but it's starting to flatten, if not go down quarter over quarter. So we'll see how this is materializing in subsequent quarters. Now, on to the corporate and investment side, paints a very, very similar story, although we don't have that strong revenue growth over here. Just steady from a corporate perspective, but they've done a nice job controlling their non-interest expenses, essentially their operating costs, up just 2% year over year. The provision for credit losses, I noticed over here, maybe they were a little bit more aggressive last year, or they set aside a little bit more money. Look at this. This is actually down 87% and down significantly from a quarter ago. So what they are seeing on the corporate side, they're not necessarily seeing on the consumer side. Corporates, they feel, are not going to default on their loans. The very cynical person could be saying that JP Morgan is just playing with their numbers here, that because they had such strong revenue growth on the consumer side, it allowed them to set aside more money for the provisions for credit losses. Over here on the corporate side, they barely had no growth on the corporate side, and so they're not setting aside as much money on the credit loss side because that would impact their net income, which again is relatively flat when you look at it from a year over a year perspective. You come over here to the commercial banking side, and it was an explosion of revenue, up over 46% year over year. And this was a quarter where I don't think we even saw much of the effects of the SVB bank and a lot of people kind of pulling their money out of these regional or quote unquote smaller banks. I don't think a lot of these are printed in these numbers. There's some effect here, but we are going to see that in subsequent quarters, how much that impacted JP Morgan from a revenue side and a deposit and an inflow side. Because again, when we looked at this corporate wide, average deposits on the consumer and the corporate side were actually down. And so that is a trend that could interestingly reverse in subsequent quarters, again, as consumers and businesses kind of flee these quote unquote smaller banks, if you will. Non-interest expense ticked up more than the other business units here, up 16%, but strong net income of 58%. It feels like we're doing a tech stock here, up 58% from $850 million all the way up to $1.4 billion. And finally, you have asset and wealth management, generally a very consistent business for the company that just prints out kind of a consistent $1 billion or so in net income. This year, an acceleration on the asset and wealth management side, as maybe more clients are pulling those just average deposits. This could be the case. People taking their average deposit and putting it more into kind of asset and wealth management type of products. We'll see if that trend continues. Now, the trend I was anticipating, okay, we'll kind of like maybe ignore the price action after last earnings call. A last earnings call was like right here, right on the edge of the graph. We were right here, right about where the stock is right now, 138, 140. And the momentum was just looking so good. The chart was looking so fantastic. We were making a very steep higher high, higher lows. The momentum was there, but then all of a sudden, it broke. We just couldn't get above the 145 level on JP Morgan stock, and we broke all the way down here to about $124 per share. That was probably, looking back, a decent area to continue to buy these shares. Now we've made a recovery. We're back where we were essentially 90 days ago. Now, the shorter term trend is still looking pretty good. You had some lows back here in October. Looks like we've made a higher group of lows here. Looks like we're going to continue to push higher. The very conservative investors out there that really want to wait for confirmation on JP Morgan, you really need to get above, I would say, probably into the 147 range. You know, in 147, you would take out these highs, could create the airspace and the momentum that I thought was here 90 days ago. That would push us into the 150s, 160s, maybe even as high as 170s, essentially retesting the highs that we made back in 2021. We're seeing other stocks do this, okay? The Nvidias, the Apples, many stocks in the healthcare space retesting highs that they made back in 20 and 21. Given these strong results that JP Morgan just put up on the revenue side and the earnings side, certainly plausible. Obviously, if those storm clouds dissipate, as JP Morgan very eloquently stated in his shareholder level. Now, obviously, the reverse could happen. We could get rejected here at 140. We could back test to this trend line. Wouldn't be a problem. Anything back into the 130s, which is essentially where the stock is right now. Really, what you don't want to see with JP Morgan is probably a retest of the 120 area. Even a retest of the 120 area could just shallow out an uptrend that you have. But to me, that would look more kind of like a rounding topping pattern. And in my opinion, we have this gold line down here, which is kind of hard to see on this graph. It goes back quite a long ways, really all the way back. You could probably extend these all the way back to kind of the lows that you made back in the 2009 era. That gold trend line is still actually intact. A back test all the way to there, which is going to materialize, I would say, over the course of this year, would take you into like the south, basically 120 or just south of that area. You get a pullback there. That is kind of the back up the dump truck moment. But just understand that if JP Morgan pulls back to 117, the doom and gloom, the banking crisis, the banking collapse crowd are going to have control of the narrative and the situation. It's actually going to be difficult to buy the shares, so that's why I would make that decision at the moment. Also, from a tangible book value, you get a decline of maybe 10-15% on this. That would put you at that probably 1.5 times tangible book on JP Morgan, which has historically over the last 5 years has been just a wonderful buying opportunity. Right now, it's an above average buying opportunity because you can have momentum push you up and retest these highs in the 150s, 160s. And if you're bullish on the overall economy, then that is probably likely to materialize. If you're bearish on the overall economy and you think things are just going to materially get worse, that is probably going to push JP Morgan stock lower, and you're going to have opportunities at a lower price in the future. I think this one's probably going to continue to move higher because these results, while you can find some holes and you can poke some holes in these, it doesn't look like to me we're going to have some kind of full-fledged bank panic or banking crisis here in the near future. Hopefully, you guys enjoy today's video. It is the start of earnings season, so we'll be back with more videos here soon. Good luck with your investments.